12 regional banks, Wall Street soon ran the show. As president of the New York Fed, Morgan protege Benjamin Strong seized control of the board's Open Market Committee operations. Strong would remain the dominant force at the Fed until his death in 1928. The Federal Open Market Committee, now based in Washington, directs the Fed's most important instrument of monetary policy, the purchase and sale of government securities on the open market. To increase the supply of money and credit, that is, to inflate, the Fed buys government securities from a few hand-picked firms with newly created money. To tighten money and credit, the Fed sells securities. In this, it can act on its own discretion.
Every government wants the ability to create new money. Okay? It's an alternative to raising taxes. Taxes, as we said, when they're raised, tend to evoke a lot of resistance among the public. It's much less painless to increase the money supply. The effects, the negative effects, don't occur until 6 months, a year, 2 years later, at which time the increasing prices can be blamed on other factors, the weather, speculators, and so on.
Another device the Fed uses to control the amount of money in circulation is setting the discount rate. This is the interest rate charged to member banks when they borrow short-term from the so-called discount window. If the Fed lowers the discount rate for its loans, commercial banks will likely borrow more from the Fed. This increases the amount of funds banks have to lend. Bank credit thus becomes cheaper, as reflected in lower interest rates on bank loans and credit cards. The increase in funds available for banks to lend also increases the amount of money in the economy. The Fed can also manipulate the nation's money supply by raising or lowering the reserve requirement. Banks are required to set aside a percentage of their deposits as reserves to meet depositors' demands. When the Fed was established in 1913, it cut reserve requirements in half over the next 4 years, doubling the money supply by the end of World War I. But the Fed's real power lies in its monopoly to create money. Although the U.S. was still on the gold standard in 1913, it was quickly eroded as the Fed continued to expand the money supply. The first step was backing Federal Reserve notes by only 40% in gold, allowing the money supply to be increased 2.5 times. The inflationary effect of fractional reserve banking was also heightened by the central bank.
The commercial banks are permitted to create checkbook money on top of Federal Reserve notes. That is to say, the commercial banks are only obliged by law to hold reserves in the form of Federal Reserve notes of 10% to back all demand deposits that they have. 90% of their demand deposits are backed by nothing.
The Federal Reserve System adds another inflationary layer to an already unstable banking system. For example, if the central bank has $100 worth of gold reserves in its vaults and a 10% reserve requirement, it can print up $1,000 of new notes and deposits, which become the reserves of the commercial banks. The commercial banks take this $1,000, and if they're required to hold 10% again in reserve, they can multiply the $1,000 into $10,000 through fractional reserve loans. So an inverted pyramid is created with $100 worth of gold or real money at the bottom and $10,000 of inflated paper money at the top. As this $10,000 in new paper money circulates in the economy, it drives prices up, therefore reducing the buying power of ordinary citizens.
When they spend that money, the people who get the new money first and are able to buy products with it benefit, and the people who get it at the end lose, because when they go to spend it, prices have already gone up, and so they're able to buy less. And so there's a transfer of wealth and of power from some segments of the economy to others because of the actions of the central bank. And basically those who benefit are the government itself, big banks, and government contractors, and anybody who's closely associated with the federal government.
By making enormous amounts of credit easily available, the Fed can also drive down interest rates, sending out the wrong signal to investors. It sets in motion an unsustainable investment boom that carries with it the seeds of its own destruction. It's this business cycle that is ultimately responsible for economic disasters such as the Great Depression. Soon after the Federal Reserve was established, the U.S. entered World War I. Once again, the government temporarily abandoned the gold standard to print more money to finance the war effort. The U.S. government borrowed heavily, and the national debt ballooned from $1 billion to $27 billion. A sharp spike of inflation followed. This set off a cycle of rapid expansion and contraction in the economy. To dampen the overheated economy, the Fed halted its inflation, causing interest rates to nearly double over the next 18 months. By 1921, the market began to recover. New technology helped to increase productivity. Markets developed for new cars and appliances. The 1920s were a period of extraordinary growth. But behind the scenes, much of this growth was distorted by a Fed-generated inflationary credit expansion.
This was the Roaring 20s. This was a period of increasing affluence. That hid the inflation from American economists.
The Fed-generated bubble burst in the Wall Street crash of October 1929. Speculators who had borrowed money to buy shares when bank credit was readily available saw the stock market lose 1/3 of its value. Bank loans totaling $7 billion were outstanding. As the speculators defaulted on their loans, bank failures spiraled, and the Great Depression set in.
Depositors lost their bank accounts, both their savings deposits and checking deposits. They saw them disappear into thin air.
In 1932, Franklin D. Roosevelt was elected president and quickly implemented a New Deal policy of spending us to prosperity. Even though we needed lower taxes and lower spending, his administration would seek unprecedented amounts of money to finance its big government programs. In his inaugural speech on March 4, 1933, Roosevelt vowed to put an end to poverty and the unemployment lines and get people back to work. It didn't work. The Depression got worse, thanks to increased central planning. FDR only succeeded in making the monetary system even less sound. Just after taking office, the president declared a 4-day nationwide bank holiday, absolving the bankrupt fractional reserve banks of any need to repay their depositors. But before the banks reopened, the Roosevelt administration had to come up with a scheme that would lead people to believe that new deposits would be safe. It created the Federal Deposit Insurance Corporation to lull the public into a sense of security. In reality, the Federal Deposit Insurance Corporation holds just 0.5% of all the deposits it insures. But what people are counting on is that the Fed, as the lender of last resort, would step in and print whatever money would be necessary to prevent a massive bank run. By the mid-1930s, control of the Fed by the New York bankers was drawing to a close. The Morgan era ended when President Roosevelt, who was no friend of the Morgans, appointed Mariner Eccles as its governor. Eccles, a Republican from Utah, moved the activities of the Open Market Committee to Washington. President Roosevelt was on hand for the dedication of a new $3.5 million building to house the Fed.
I dedicate this building today to progress toward the ideal of an America in which every worker will be able to provide his family at all times with an ever-rising standard of American comfort.
1933 also marked the beginning of the end for the gold standard. There was no end to Roosevelt's appetite for spending on such New Deal programs as the gigantic $13 billion Tennessee Valley Authority, which flooded vast areas